Talking about Warren Buffett means talking about wisdom, teachings, and above all, money. For more than 5 decades, his strategy has been a secret, and today we bring it to you, explained in these 5 rules that will lead you to achieve wealth in a short time. First, Warren says that you should not buy a stock unless you are willing to hold it for 10 years. This means that you should not buy a stock today, tomorrow, next week, or next month unless you are prepared to hold it for a long time. You must be prepared both financially and mentally to hold it no matter what happens in the market. Warren Buffett has always said that investing is a game of psychology rather than intelligence. Part of that is focusing on the long term. Warren has a famous quote that says, "Don't hold a company for 10 minutes unless you are prepared to hold it for 10 years. This helps you avoid thinking about investing as a game and instead focus on the actual business you're buying. Giving great companies time to grow over time is exactly how Warren made his fortune. For example, some of the companies Warren has invested in include American Express, Coca-Cola, Bank of America, Visa, and Moody's. These are all excellent investments to have in your portfolio, but he has also held each of them for over 10 years. In fact, Buffett first bought shares of Coca-Cola in 1998, spending a total of about $1.3 billion. Buffett's second rule is simply not to lose money. The first rule of investing is not to lose money, and the second rule is not to forget the first rule. If you buy shares of companies that are undervalued, their market value is less than the true value of the company, and you do this with several companies, then you have a good chance of making money in the long run. This is because, over time, the market usually corrects these undervaluations, and the stock price rises to reflect the true value of the company. It may seem obvious, but it's a rule that changes the way you think about investing in the stock market. Even if you only get 6 out of 10 investments right, you can still make a good return. The important thing is to control the risk of the investments that don't work out. Warren says the most important thing you can do when you're in a hole is to stop digging. This is very important when investing in the stock market, but also very difficult to do. When you start losing money, the tendency is to convince yourself that you need to invest more to recover. But sometimes the best thing you can do is just accept your losses and walk away. Another important Buffett rule is to always buy below intrinsic value. The only reason to invest money now is to get more money in the future. That's what investing is all about. It doesn't matter how many analysts recommend it or what the stock chart looks like. Whether you are buying a farm, an apartment building, oil in the ground, or stock in a company, you are investing money now to get more money in the future. If the price of the company's stock is less than you are willing to pay, then you are buying below intrinsic value and you are doing a good job. The process Warren uses to calculate intrinsic value is called discounted cash flow analysis. In other words, it's about calculating how much money the company will make you in the future and how much you'd be willing to pay for that money today. It all started in 2016 when Buffett saw something special about Apple. He noticed that the company had something called a moat in the financial world, which basically means that it had a very strong competitive advantage. In other words, Apple was in a position where it could continue to make a lot of money in the future, even more than it was making at the time. To measure whether an investment is a good one, Buffett uses a metric called the price-to-earnings ratio. What's interesting is that he bought the stock when it was trading at 12 times earnings. Why did he do that? Because he expected Apple to continue to generate a lot of cash in the future, which would make the stock even more valuable over time. Looking at the present, we see that Apple's market value has grown tremendously this year, reaching $3 trillion. In addition, its free cash flow, which is the money the company generates after paying its expenses, has increased from $53 billion to $111 billion per year. In short, Apple has become a more valuable lesson. If you're not sure, you're better off not investing. And that brings us to the fourth rule. Don't get attached to companies you don't understand. This philosophy is based on Buffett's belief that you should only invest in things you thoroughly understand. But what does it really mean to understand a business in the context of investing? It doesn't just mean knowing the details of how a product or service works, but rather how that will play out over the long term. Buffett looks for businesses whose prospects he can predict over a 10 to 20-year horizon. One example Buffett uses often to illustrate a common mistake is buying stocks without really understanding the company behind them. This can cause problems when the value of the stock starts to fall. You don't have to be an expert in all aspects of investing, but it's important to recognize what you do and don't understand. The fifth rule has to do with investment psychology and refers to a famous Buffett quote, "Be greedy when others are fearful, and fearful when others are greedy." Buffett recognizes that people often get caught up in the emotions of the stock market. When everyone is excited and greedy, they tend to buy at high prices. And when the market is fearful, people sell at low prices for fear of further losses. Buffett advises countering this tendency by being cautious when everyone else is buying impulsively and, conversely, being ambitious when everyone else is scared. The idea is not to get carried away by market emotions and to make investment decisions based on sound, long-term analysis. These 5 rules will give you everything you need to start making money in 2024. Are you ready to be an investor like Warren Buffett? Subscribe to the channel and turn on notifications so you don't miss any new videos.